Today, we're looking at an investment analysis on Opendoor Technologies, or OPN, which argues it's a sleeping giant thanks to a radical AI pivot and new leadership. So let's just dive right in. Our first high-level observation, and it's a big one, is about how the analysis needs to better align the company's financial runway with its execution risk.
Right.
Basically, it needs to use the company's strong cash position to, directly bolster confidence in this really high-stakes AI pivot they're attempting.
Yeah, I felt that disconnect pretty strongly.
The material does a good job identifying the core challenge, which is execution risk. I mean, firing 90% of your staff to automate home pricing, that is massive.
It's huge. And the analysis says it, right? Pivoting to AI is great on paper, but firing 90% of staff carries massive operational risks.
Exactly. But then the safety net, the $962 million in cash, is tucked away pages later. It's under a sort of generic financial reality check section. And by separating those two elements, the risks just feels immediate and almost existential. It doesn't feel like a calculated, financially backed transition.
It doesn't. And that's the thing, that billion-dollar safety net is the only reason this thesis is even plausible. When I was reading it, my first question was, okay, what happens if this new AI fails for like 2 quarters?
Right.
And with the risk presented so separately from the cash, the answer feels catastrophic, like the company just implodes.
So how do we fix that? How can we make that integration more explicit?
Look, the analysis has to fuse them. The strength of the balance sheet is the only thing that gives management the license to make a 90% headcount reduction.
So you're saying use the financial strength as the reason they can afford to be so radical.
Precisely. Otherwise, it just looks like operational hubris. It doesn't look like a responsible, calculated gamble. The way to do it is to stop treating the cash figure like a static metric.
And make it an active part of the bull case.
Yes. Instead of just listing the $962 million, you link it directly to execution risk. Call it the runway that's there to absorb losses if the AI isn't perfect right out of the gate.
Okay, so make it tangible.
Extremely tangible. You take that negative $90 million net loss figure from Q3,
Yeah.
and you do the math right there in the analysis. Show the reader that this cash position provides, more than 10 quarters of buffer at the current burn rate. That's almost 3 years.
That completely changes the narrative.
It changes everything. It shows that even if the AI stumbles, the company won't implode. It demonstrates that management has bought the insurance policy before getting in the race car. Okay, that's a huge improvement. It turns a scary risk into a fully funded strategy. Let's move on to the engine of this whole thing, the data moat. The analysis brings up Eric Jackson's 100x call, which is a massive claim, and it compares Opendoor's potential to Amazon automating retail. So our next critique is this. To justify that kind of projection, the analysis has to give a lot more detail on how this, quote, massive data set actually creates a sustainable competitive advantage.
Right.
What is the actual moat?
While the weakness here is a classic case of assertion versus demonstration. It's very high level. It just calls the data massive.
Yeah.
But this whole high conviction case rests on the quality of that data, and it's never really detailed. It needs to clarify why Opendoor's data is fundamentally better than what a competitor like Redfin or Zillow could get.
Because that's the whole bear case, right? If the AI fails to price homes accurately, the losses could just explode. So if everyone has data, why is Opendoor the one that's supposed to be revolutionary?
You have to show the receipts.
Exactly. You're selling us the 100x return, but you're not showing us the engine that delivers it. The whole sleeping giant idea is that this company spent years gathering proprietary intelligence, and now the version 2.0 AI is finally weaponizing it.
So it needs to get specific.
It needs to get very specific about what makes the data unique. And the history of the company is the key. The report mentions Opendoor was a capital-heavy flipper for years.
Okay. That's the distinction. Think of it like this. Everyone has access to public MLS data. That's, just standard Google Maps.
Right.
But because Opendoor was actually buying, holding, sometimes losing money on these properties, their data set is filled with distressed, complex, weird transactions. They have data on why a house failed to sell or what it really cost to fix a foundation in Phoenix in 2021.
Ah, so it's not just they have data, it's they have battle-tested, high-fidelity risk data.
It's failure data, and that's the moat. That's the stuff that's impossible for an AI to learn if it's only trained on successful sales. This is an irreplaceable asset.
Okay, and so the analysis needs to define that. define it, and then link it to future strategy. The report's inventory section says they're being really cautious right now, buying fewer homes. The suggestion is to show how this new AI, powered by that unique risk data, will let them start increasing their buying again, but in very specific low-risk segments where the model is hyper-confident.
So you connect the data moat directly to future revenue growth.
Exactly. It's not just about cutting costs. It's about how the data lets them re-enter the market smarter and faster than anyone else. It gives that 100x case a real, tangible pathway forward.
That makes a lot of sense. It makes the past feel less like a failure and more like R&D for the future.
Right. Okay, let's move to the conclusion. The analysis does a great job of talking about both the long-term potential and the short-term market stuff, like the warrants. So our final critique is this. The conclusion has to do a better job of separating the short-term trading momentum from the multi-year investment thesis. Yeah, it kind of conflates the two at the end.
It does. It captures that short-term bullish momentum really well. The 10x rally, the JP Morgan target, all that stuff about a potential gamma squeeze from the warrants.
But then the final verdict, the main takeaway, is just a technical trading trigger. Watch for our break above 850, which is fine for a day trader, but
it completely undercuts the huge 0 or 100 AI turnaround story, which is a multi-year thing. It makes this grand thesis feel like it all comes down to a single day's price action.
it's a classic case of confusing the signal with the noise. And, just to explain that technical jargon for a second for anyone who isn't deep in it.
Yeah, please.
When it talks about a gamma squeeze, it means there are these big blocks of options that force market makers to buy the stock as the price goes up. It creates this short-term, self-fulfilling price spike that is totally separate from whether the company is actually succeeding or not.
Okay, so that context is vital. Knowing that, how do we guide the investor who actually believes in the version 2.0 overhaul and cares about 2026, not next Tuesday?
Simple. The conclusion needs two distinct validation metrics, not just one.
Okay.
First, you can have the momentum trigger. That's where you talk about the price action, breaking 850, the warrants, all of that. That's for the traders.
And the second one?
The second one is the long-term validation metric. This has to be a non-stock price metric that proves the AI pivot is actually working.
Something fundamental.
Exactly. The whole point of the V2 pivot is using automation to crush costs. So the analysis should define a specific, quantifiable metric to track that. For example, a target for cost per transaction or a specific gross profit per home that management needs to hit by, say, Q1 2026.
That gives the fundamental investor a real benchmark. If they hit that number, we know the AI is working, no matter what the stock price is doing that week.
Precisely. It validates the actual high conviction thesis.
All right, this has been really focused. Let's just quickly summarize the three main actionable suggestions for the listener to implement in this Opendoor report.
Sounds good.
First, integrate that $962 million in cash directly into the risk analysis. Make it an active safety net that explicitly justifies the 90% headcount reduction.
Yep.
Second, quantify the unique competitive advantage of the dataset. Define that specific distressed transaction data they have and link it directly to future growth to really support that 100x claim. And finally, refine the conclusion. Create two distinct validation metrics, one for the short-term momentum traders based on price, and a second fundamental metric, like a target cost per transaction, for long-term investors to prove the AI strategy is actually working.